Dunham Quarter in Twos gives you a concise outline of what we view as the most notable economic events that occurred this quarter, involving domestic markets, international markets, and the bond market, all in about 2 minutes. Just like the cold weather brings about changes in fashion, the chill in this quarter's market has led investors to bundle up. Investors began this quarter with leveled hope for stabilizing interest rates and lower inflation. As the third quarter began, the hopes for lower inflation were answered with better inflation news received in August and September, but the hopes for interest rates remained unrealized as they got worse and significantly increased by quarter end. In the domestic equity markets, investors saw a strong July and first half of August, followed by a sharp decline as the quarter came to an end. The market started the quarter with an optimistic outlook, talking of the possibility of eventual rate decreases in 2023. Investors felt the air warming and began to discard their jackets, and this optimism led to a decent rally in the stock market. This balmy weather did not last. In the final weeks of August, after a hawkish speech from Fed Chair Jerome Powell, the market began to decline, following the trend from the second quarter. Investors once again felt the need for a coat to bundle up against the growing cold, as September posted its biggest monthly decline since 2009. While bonds have often been a warm coat when equities were chilly, it seems bonds were just as cold this quarter. The Bloomberg Global Aggregate was down 6.94% these past 3 months. Investors saw bond yield rise, and as a result, bond prices fell. However, there was a pocket of warmth in the cold of the fixed income market. Floating rate bond funds, a non-traditional fixed income class, performed relatively stronger than the rest of the domestic bond market, at least enough to warm investors' hands with a positive return for the quarter. Similar to previous quarters, the Eurozone continues to combat inflation by raising interest rates. The MSCI ACWI was down 6.82%. Because the U.S. Treasury yield is higher than its peers in the Eurozone, the United States dollar has appreciated against other foreign currencies. The strong dollar put pressure on other central banks to increase their bond yields. Emerging markets faced a similar change in market temperature felt by the rest of the world. With China's zero-COVID policy, emerging markets took a turn for the worse. The market decrease caused by this policy offset their lower interest rate advantage from last quarter, bringing them to put on their scarves like the rest of the world's economy. With the United States Federal Reserve refusing to back down on the tightening of monetary policy and the slowdown of the global economy, the last quarter of 2022 may have a rocky start. As investors head into the fourth quarter, they should keep a lookout for interest rates and inflation, because any easing in either could lead to a warm, gentle breeze which could benefit the stock and bond market. Remember that investing is a long-term endeavor, and investors should make decisions with this in mind. It's essential to keep a calm and steady mind in every market. In conclusion, enjoy the beautiful fall colors and be aware of changing temperatures on the wind. Please subscribe to our channel to stay up to date on the latest Dunham insights.